It was another defensive day in the grain markets, with corn taking a leadership role in the price setback. Beans and meal were lower, while bean oil found a way to close higher, and wheat saw modest losses too. But the cattle complex was sharply lower, with moderate losses in lean hogs, and cotton saw another round of losses too.
Live from a round of losses, part 2, the Ag Reckoning, via Farm Journal broadcast. This is AgriTalk. This afternoon, it's a conversation with Darin Fessler from Lakefront Futures. Directly following the news, Brian Splitt from agmarket.net. Me, I'm handsome newsman Davis Michelson. Now, welcome the host of AgriTalk, Chip Flory.
All right, Davis. Hey, thank you so much, and welcome to AgriTalk. Glad that you are with us on this beautiful middle of October day, 54 degrees out there. It feels a little cool, but Davis, it only feels cool because it's been so warm leading up to this. Normally, mid-50s in the middle of October would feel pretty good.
Yeah. We're 58 here, 58 and sunny.
Okay.
We had significant cloud cover. It looked like, I honestly, and maybe I haven't seen it in so long, but it looked like the sky was trying to remember how to make water come out of it for just a second there.
You know why?
Couldn't find the recipe. Yeah, didn't get it.
Do you know why it didn't?
Why is that?
Because it's too dry to rain.
Of course. It's too dry to rain.
It's too dry to rain.
Mm-hmm.
Yeah. I've been laughing about it ever since I said it this morning. How stupid could that be? But
no, that's
I get
that's
it.
The thing. There
Yes.
isn't enough moisture in the air for it to coalesce and become drops and hurl themselves our wayward.
Yes.
That's a thing.
We're
It's
looking
science.
for it. Yeah, it is. There's something to it, no doubt about it. All right, we've got Brian Splitt coming up here in just a little bit. We're going to take a look at one of the markets and see what Brian thinks about today's price action. Boy, defensive in nature all the way across the board, and really tough in the cattle complex. But corn, Davis, it almost feels like corn is starting to lead the way to the downside in here right now. I don't know if I care for that or not. And Darin Fessler coming up in the next segment. Looking forward to the conversation with Darin.
Yeah.
All right,
good.
man, let's get to the news.
Indeed. Well, export inspections of wheat in the weekend at October 10 totaled 371,000 metric tons. That was in line with trade expectations. USDA this morning also announced the sale of 120,000 metric tons of soft red winter wheat for delivery to Mexico. That's for the current marketing year. Even with improved demand and with the U.S. dollar under pressure, wheat traded on the defensive all day. December SRW wheat futures posted a high-range open and a low-range close and closed below 580 for the first time since September 24. December HRW wheat futures 7 cents lower, 583. December soft red wheat down 5 3/4 cents to 579 1/2. December spring wheat closed at 616 1/4. That's down 10 1/4 cents today, Chip.
580 was such a pivotal point for that December SRW futures, and here we are closing back on the downside of it today, only by a half a cent, but nonetheless, that's an important close in Dece SRW wheat.
Well, Chip, corn export inspections totaled just over 430,000 metric tons. That was below trade expectations and down sharply from the previous week. Another interruption to rail shipments into Mexico was a negative on corn prices, as was the generally defensive nature of today's trade. Mexico is also pursuing a ban on imports of GMO white corn. That threatens to create another trade dust-up with Mexico in the near term. December corn futures closed lower for a fourth consecutive session, and today's session high open and low-range close accelerated the downturn. Today's close in Dece corn, the lowest since August 30. December corn futures today 7 cents lower, 401 1/4. March corn down 7 1/4 cents to 417 1/2. July corn futures closed at 431 1/2, down 6 1/4 cents, Chip.
Yeah, not a very healthy close in Dece corn today. I do not like that session low close that we had.
Yeah. Export inspections of soybeans week ended October 10 totaled 1.575 million metric tons, down slightly from the previous week, but in line with trade expectations. USDA this morning also announced the sale of 131,000 metric tons of beans for delivery to China in the current marketing year. Price pressure was also the result of expected increased rain in Brazil's key soybean production areas. Soybean oil shrugged off the pressure from sharp losses in crude oil futures, but lower soybean meal trade did pull soybeans lower. November beans gapped downward for a second consecutive session, firmed to fill that gap, and then posted a high-range close. Still, November beans were a nickel lower, $9.91. January beans down 8 cents, $10.03 1/2. March beans closed at $10.16 3/4. That's down 8 1/2 cents, Chip.
Yeah, and on the day, December soybean meal was down $3.50 a ton, $3.11.80 on the Dees meal on the close. Dees bean oil up 55 points to $42.45.
Well, December cotton today was 41 points lower, $70.62. On your livestocks, heavyweight choice graded boxed beef prices were $3.04 higher this morning on good movement of 73 loads, but that was not enough to prevent a round of profit-taking, Chip. December fat cattle opened slightly lower and near session highs that posted a mid-range close. These fat cattle $1.40 lower, 186.52 1/2. November feeder futures $3.10 lower at 246.47 1/2. And on your snout side, December lean hog futures 57 1/2 cents lower today, 75.22 1/2. The February contract down 52 1/2 of its own, 79.30. Chip Lorry.
All right. Thank you very much, Davis. Yeah, that heavyweight choice graded box beef today, 316.36 is where it traded to this morning. So big numbers there. All right, Brian Splitt, eggmarket.net. How you doing, Brian?
I'm doing great, Chip. What's going on?
Well, I'm watching these markets slip sliding away. Which one are you watching most closely?
I'm looking at the December and February live cattle, and both of those contracts made it to some pretty significant resistance. The February has that long-term downtrend, and that's from September of last year to March of this year to July of this year. And we were up against that trend line to start the week and to finish the week last week. And we're starting to see some rejection of that resistance. And when you look at the December contract, and this goes all the way back to essentially the May highs and then our July highs, 188 in general has been a tough level. We might trade through it a little bit for a day or two, but we keep rejecting that. And those rejections generally lead to a move back to somewhere in the 83.50 to 82 area. Although we have seen deeper corrections off of these levels all the way into the mid 170s. So it's just a matter of, I think, how deep is this correction going to be? But with these failures at trendline resistance and up against previous month's highs, I think there's some downside to go yet in cattle.
Yeah, I do not like the momentum that is building in this market right now either. It just it feels like, and I know that we shouldn't go off of feels in here, but it just feels like today was a very important day in that live cattle trade. I'm glad that you focused on it. Boy, trade under 185 and kind of look out below, right?
Yeah, I mean, again, we've seen some quick corrections to 83.50 to 82.
Yeah.
So, but you've got some moving averages right there at about 85.50. That's the 20-day, and then below that, you're talking 84 for the 200-day, and then the 100-day at 83.50. So, we could very easily take off 50 cents to a buck, very quickly if we start breaching those.
All right, Brian, it's always good analysis. Thank you, my friend. I appreciate you.
Always good to be here. Thanks.
All right, Brian Splitt, agmarket.net. Coming up next, conversation with Darin Fessler, Lakefront Futures, here on AgriTalk.
We've cleared the schedule for you. Give us a call at 855-482-5524 and join the conversation. Hey, Chip.
Hey, David.
I think I've drawn a new correlation.
Oh, boy.
Soybean oil. Let's go to the Dees, up 55 at 42.45. The other market in green, directly adjacent, the Class 3 milk up into the low 20s. The October 22.54 Nove at 21.14 today, up 35 on the day.
All right, so am I hearing
Clearly there's a correlation.
Liquid futures?
Yes, liquid futures. Uh-huh.
All right. Well, crude oil's against you on this one, but I'd hate to consume much of that crude oil, direct. Soybean oil, I'm sure you could handle a little bit. Milk, bring it all day.
Yeah, let's have milk. Yeah.
Crude oil.
Mm-hmm.
I don't know if we should do that or not. By the way, crude oil today, November contract. Let's see, what
Kinda
is
came
the
back
latest?
a little bit.
Yeah, it bounced off the lows. I was going to look and see. Down 281 right now is what I've got. It's 7102.
Mm-hmm.
So heavy day of pressure on the crude oil market. Darin Fessler, Lakefront Futures, is our guest analyst today. How you doing, Darin?
Hey, thanks for having me back on. I appreciate it.
You bet, man. You bet. What are you hearing from guys over there in eastern Nebraska?
Well, incredibly dry bean and corn conditions. Just absolutely. There's field fires every other day around here. But that's pretty much a growing consensus across the entire belt, no matter if it's Nebraska or Ohio. Everything's extremely dry.
Yeah. Yep. Some there's been some argument out there on social media whether or not these dry crops actually result in lower yields. I don't know how it doesn't. I mean, if you're not weighing as much water as they go across the scale, you're not weighing as much yield, right?
Yeah, I think that's a fair statement.
Yep.
But what I'm continuing to hear is yes, yeah, we got some bean conditions that are down to like 6 and 7%, and corn down to 11 and 12%. But on the same coin, well, the yields are still there. There's pockets, and you can go to north central Iowa, you can go kind of the northwest Iowa as well. There's pockets where yields are off, and they're going to be off in numerous places around the country. But the general consensus here is yes, it's dry, but the yields are still there in general. And I agree with what you're saying. And that's some of the reason why I'm using like a 181, 182 type yield. I think at the end of the day, that's where we'll settle. And in about a 52-ish, maybe down to a 51.5 on the bean yields at the end of the day, because I think that the USDA, for whatever reason, I mean, they're not willing, I think, to push it right now. I think that you have to start calculating for some of these drier conditions that we're seeing. And I think in time that they will. And I think in general, though, I mean, if you don't get a huge adjustment from there and we get some better weather in Brazil, we still have a lot of issues out there. I mean, no question about it. I think the biggest issue is probably beans, and then corn probably second.
Gotcha. Okay, so taking what we learned last Friday in the supply and demand balance sheets and applying your thoughts on what yields might be here going forward, tightened up a bit more on corn, but even if it tightens up a little bit on beans, it's still going to be tough to talk a bullish story there, isn't it?
Yeah, that's another fair statement. I think that when you look at the corn side of things, and you would have told me 6 months ago that we were going to have near 184 yield and a carryout sub 2 billion, I would have said you're probably lying. I mean, that just goes to show you the type of demand that we have built into the balance sheet, I think, for the U.S. And it's just an incredible number to deal with when you're talking that type of yield. Now, again, that could be favorable going forward, though, because with my assumption is that, hey, we're going to probably see a downtick in yields. But again, does that move the needle for corn price-wise? I think corn is much more of a range-bound trade here, as goes wheat, as goes corn. I've been saying that to subscribers for a long time now. Okay. But if you start to get a little bit better feel in weather, and that, the weather is more favorable in the Black Sea, what does that mean for wheat? I think wheat has a really decent story here. Corn is kind of doesn't. It's just kind of in limbo. The problem is beans. No matter how you slice the pie, there is the USDA a little bit too optimistic on the demand balance sheet, or the demand side of the balance sheet, if Brazil does have a decent crop. And I think when we look at and we consider both of those aspects, maybe the USDA is a little bit timid right now to say, hey, we're not going to cut some of these exports just yet because of what's going on in Brazil. We still got to get these rains. They still got to get it planted. Well, let's see how that situation pans out. And then maybe down the road, we start lowering things here and there. But right now, we're in the heart of, hey, China better be buying our U.S. beans, because when you get to the January, February, and even the April timeframes, the U.S. market gets just exponentially less competitive versus the Brazilians. So again, the U.S. bean market, we need some help. And we need probably some luck on our side too as well. So hopefully, after the election, we get a little bit better policy outlook here going forward. Hopefully, knock on wood, a little bit better relationship with China. They can come buy some of these beans from the U.S. because that's really at the end of the day is what we need. We need a lot better demand.
Yeah, yeah, and by better demand, we got to acknowledge the fact that there was a bean sale announced to China today, 131,000 metric tons, but it's got to be more than that. And more importantly, it's got to be more consistent than what it has been. Fair?
That's a very fair, yeah. And we should be making sales to China. This is the time frame of year where China is actively buying U.S.
Yep. And we need some help there. we definitely do. Okay, so talk to me about the relationship. Because you said that so goes wheat, so goes corn. So what do corn growers need to know about global wheat trade right now?
I think the big focus is you've had some issues in the Black Sea where it's just incredibly dry. You've had some germination issues start to develop, maybe questioning what those acreages may be. We obviously know what's going on in the Europe market and France and Germany. Their production year over year has really taken a hit. You've even seen some little bit of privates in Australia start to dwindle down some of those production figures as well. You've seen, year after year decline in stocks use ratio of the major exporters in that market. The problem with the wheat market, you really started to roll over here the last couple of days here, and you've seen that acceleration lower in corn as well, and you've taken out some key support levels. And again, I think that some of this is a lead up to option expiration here in the November contracts. But I also think you're also seeing that mid-harvest hedge pressure as well come to this market where the funds, I've called it a perfect storm this whole year from the funds where they have been able to cover a significant amount of their shorts without really moving the price a whole heck of a lot.
Yeah.
And now they got a little bit more ammo in their tanks to get back short this market with the USDA numbers that we've recently have seen. And now you're given the idea, hey, if Brazil comes back to this market and gets rain, what does that prospect look like? And we've seen some huge numbers out of CONAB this morning. Just gets the market a little bit nervous because the macro environment with crude oil down 4%, the macro is just very wish-washy, even with the Chinese stimulus going on.
Yeah. Yeah, I want to talk a little bit more about that Chinese stimulus because I'm trying to gain a better understanding of what exactly it might mean for us going forward. But first, talk about one of the influences of a tough economy in China is what's happening in this energy market. Is that right?
I trade a lot of crude oil, and I think that crude oil is just a metric to follow. I've always said this. I think if you are an ag guy, it is so much better to have $80 and $90 crude. And even though we've seen stimulus from not just China, but elsewhere around the world, we've even seen some interest rate cuts here. It seems like crude oil, even with the headlines in the Middle East and escalations in the Black Sea, you can't get crude oil off the floor like you did 2 years ago. That you got to take note of that. And so that in itself is just, I think it's a weighing on things, the global aspect of growth and what does that mean for crude oil, not just crude oil, but what's that demand story look like from China? I think it's a huge one in the back of traders' minds. And to me, when China's trying to throw every dollar and every policy at just to stimulate that economy, I question how bad is China's growth, and are they really telling us the whole story about they're growing at 4 or 5%? I mean, I've been in the camp. You kind of take what they say at a little bit of face value, a grain of salt, if you will, and I don't think China's growing as nearly as strong as they have said in the past. And I think that really goes to show how bad that economy is. And sadly, that puts a back burner on the U.S. producer.
Okay, I want to talk more about that. If China's economy is as bad as indicated, by all the stimulus efforts that are out there. And we talk about, hey, this bean market, it's not going to come alive until that consistent, reliable demand comes from China. Yeah, the odds of life in the beans are pretty low then, is what it sounds like.
Let's go to the markets page at profarmer.com and check today's closes, where December HRW wheat futures were 7 cents lower at 5.83. December soft red wheat down 5 3/4 cents to 5.79 1/2. December corn futures 7 cents lower, 4.01 1/4. March corn down 7 1/4 cents to 4.17 1/2. November beans were a nickel lower at 9.91. January beans down 8 cents to 10.03 1/2. December cotton today 41 points lower to 70.62. On your livestocks, December fat cattle were $1.40 lower at 186.52 1/2. November feeders $3.10 lower, 246.47 1/2. December lean hog futures 57 1/2 cents lower on the day, 75.22 1/2. Get more market news every market day. Visit tryprofarmer.com. Opinions expressed on AgriTalk do not necessarily reflect the views of Farm Journal Broadcasting, affiliate stations, or sponsors. In the morning, you're coffeeed up and you're thinking. In the afternoon, you've calmed down, but you're still thinking. We're here all day. AgriTalk.
We're in the middle of a conversation with Darin Fessler, Lakefront Futures. Darin, I want to spend just a little bit more time on this, and that's that Chinese demand. Because if China's economy and China's economic activity is so slow that they are jamming stimulus out there as, at a pace that I don't remember ever seeing before, boy, we shouldn't count on China for any consistency in demand, right?
No, not at all. I'm concerned that the type of stimulus we're seeing is kind of showing. It's kind of like playing poker. You're kind of seeing the other player's hand, and I think that what we're seeing is, okay, you're telling us you got a really bad situation, but you're leading the market to believe something else. And I think some of the reason to do that is I think China is scared the flight of capital is going to leave the country. I think that's why they're not telling the whole side of the story. I think it's really bad in China. But again, that inconsistency is going to breed in people's minds and traders' minds. And really, at the end of the day, it's not just affecting the U.S., but if I'm a Brazilian producer, I'm concerned as well. I think the demand, not so much concerned if I'm a Brazilian producer, but U.S. I mean, we've been the back burner of their demand side of the story for a while now, and I don't think that's going to change. So, yes, the Chinese issue with me it's a pretty big one. But I'm not ruling out that things can't change. I mean, we're still planting in Brazil. I mean, that crop's a long ways from being harvested. But we continue to follow the momentum and continue to follow the trend. And right now, it just does not feel very good for the price.
Right. Okay. Yeah, but we need to keep an eye on what's happening with China and those efforts to stimulate the economy. No doubt about that. Okay, I want to go back to something else that we talked about, and that is this harvest pace out there, Darin. What's it doing to the markets? Are the markets doing a nice job of absorbing this super fast harvest pace? And what does it do to marketing strategies?
Yeah, I think it really does. I think we're getting to a point now. We're getting probably to that midpoint of harvest, and guys are maybe running out of some storage, or maybe looking to move bushels for cash flow. So again, I do think there's probably a little bit of hedge pressure. We have 10 days until option expiration in a November bean contract. So again, I think there's probably a little bit of hedge issues there as well. But again, you've seen a lot weaker crude over the last couple of days here. And so again, that is kind of hammering that idea, hey, that weak macro idea. So again, when we see these rallies, even when we were a month ago, it would say, hey, about every 20, 30 cents, we're still in an environment, you got to reward corn. Every 50, 70 cents, you get those in beans, you start rewarding it. Because I don't think structurally we're in a market that's just going to run and run, because we're not in that demand story yet. We're in a supply-driven is outpacing demand story. Just hasn't flipped yet. And it might flip, who knows? But we're still in the camp, say rallies are selling opportunities for right now, whether that be a selling HTA, whether that be option strategies, buying a put, selling call against physical. We've been doing a lot of that. Right now, we're saying, hey, we want to be 85% covered at least on corn. And right now, if all the hedges, HTAs, options, we're 100% covered on beans because the outlook on beans is necessarily a little bit more bearish than corn. I think there's a very real possibility that, come January, February, or maybe even December timeframe, that we could see beans maybe test those lower nines. And the reason I say that is because of where we have been historically with the type of stocks use ratios, not just domestically, but the world stocks use ratios are really, really burdensome right now. So again, I don't want to predict the prices, but just the way the fundamentals look, if you get the trend and the momentum to back that trade because of the weak fundamentals, it's definitely a possibility. And that in itself, I do think there's a lot of things going for corn, given I do think yields a shade high. I think maybe the bean yields a shade high. However, it's going to drag corn with it, I think, to a certain extent.
Yeah. Corn's caught in the middle here. If wheat continues to go down, corn's going to have to follow wheat. But if wheat would stop going down and give corn a chance to go to the upside, you could at least stop the pressure or slow the pressure on the soy complex, right?
I think that's that's a very fair statement.
Yeah.
And the thing is,
I was just going to say it seems like they are all so connected right now. And I don't think it's all that unusual. It might be unusual for the time of the year because of that super fast harvest. Like you said, guys have got to be getting to the point that they're running out of some space out in the on-farm storage. And if that starts coming to town, the basis break that I anticipated that really hasn't happened yet in most spots, Darin, I'm afraid that is still a possibility, isn't it?
If you're seeing basis, and again, this basis play is going to be very localized. There's going to be some pushes in certain areas of the country because of weather issues. So those guys are even money or 5 or 10 over. You're the anomaly. But when I'm looking at, I drove out the countryside this last week, and then there's piles and two huge piles at this one facility I follow closely, and it's 50% harvested. So I'm like, where's all this extra corn going to go? And so if I'm in these areas that, hey, I'm 50% harvested and the piles are already coming up, and I'm getting maybe a push on basis because the guys are not willing to sell, I got to be really looking at that basis plays right now. Because I think once harvest is done, once cash flows have been met, it is locked the bins until basis push or the market rallies, one of the two. But if you get a really friendly basis here in this time frame of year, given what I'm hearing around the country, I'm locking basis and maybe looking to hedge rallies, sell rallies in that mindset.
Okay. All right. Very good. Very good. You watching the livestock trade at all, Darin?
Yeah, I think Brian made some excellent points. I can't agree more with him. I think cattle's getting a little bit toppy here. Fundamentals remain really strong. I don't know why we don't need to argue about that. I mean, cattle's fundamentals are really, really strong. Just look at the cash markets here. But I agree with you. It feels on February and even April fats, we're getting just a little bit, tired up here. And it feels like it wants to break, just hasn't really broke down a whole lot just yet. Mm-hmm. I feel like you one headline away or a big macro issue and boom, we're down hard. I think if you get equities down, 2% in 1 week or a couple weeks and boom, I think cattle's going to follow with it.
Yeah. I don't like the way that it traded today, but I like the way that the cattle market is traded overall. Because like you said, the fundamentals are in place for a price-friendly scenario, price-friendly trade in here. I'm not saying that it's got to go sharply higher. A lot of that work has already been done, and plus you got to leave a lot. If the quote unquote cattle market is going to do any rationing of demand at this point, it's going to have to happen in the cash market, the beef market, and good grief, heavyweight choice graded box beefs today up over 360, a big rally, got back over 316. Yeah. Jeepers,
Yeah.
criminy! How is the consumer still buying beef in this environment?
Where there's a will, there's a way. I mean, that's the way I look at it. My concern would be, yeah, it's the cash very friendly, but if you're buying cattle here, I mean, where's your breaks at? I mean, I'm not saying we're going down here and we're falling $20 out of the sky here. I'm saying, hey, we probably should be looking at just trying to protect some margin when you're trying to sell it here. And so the levels I'm watching here on the February fats here, I'm looking at 186.30. April fats, I'm looking about 187. Any type of movements below there, consecutive close below there, cattle's going to go roll back down where Brian was talking, probably those mid 180s.
Okay. All right. Are you watching what's happening in lean hogs at all?
They've had a good run. They've had a really, really solid run. The thing there is, I think twofold here. I think one, it comes down to China. Two, we have some cheap feed here. Three, if you've had this nice runs here and you got some good margin there, why not hedge off some risk here? And that's the way I'm looking. We've had a good move here.
Yeah. The funny thing is I talked with Joe Sheely from U.S. Meat Export Federation last week, and we talked about the fact that pork exports are on a pace to get to a record level this year, even without China in here. But even if we were at the same level and China was doing most of the buying, we'd probably be seeing hog prices higher because it's China. That's the influence that they have. That's what makes China the wild card, whether we're talking about soybeans or corn or wheat or pork. Without China playing along, it's difficult to generate that upside momentum, isn't it?
Yeah, and we're talking about, I come on here and I always talk about those exponential moving averages where these hogs, we settled right at the 20-day. And to me, you get a level below that 75-15 level, all things you're talking about, if China's a little bit stronger, I'm friendly hogs. But if this thing starts to roll over here, there's a lot of air below here because of the run we've been on these D's contracts. So again, we settled right at a key level. I'm watching closely. Tomorrow I think is big. I think the rest of the week's big on hogs, to be honest with you.
Yeah. Okay. All right. You got some meetings lined up for this winter, Darin?
I'm always trying to have meetings. When you work with over 300 guys for every nook and cranny, it's hard to get to everyone. But it's I'm planning on being pretty busy.
All right. Sounds good, man. We'll get you back on here and learn what you are learning from those guys later this year. Darin, thank you so much, man. I appreciate it. All right.
Yep, thanks so much.
Darin Fessler. Yep. Darin Fessler, Lakefront Futures. Some interesting comments there about what is going on and what demand matters and the China influence on these markets. It's real. Davis and I will be right back.
You're listening to AgriTalk, where the conversation begins. Join us at 855-4-TALK-AG. Welcome back to AgriTalk, everybody. Really glad that you are here with us. I am Davis Michelson, the handsome newsman. Chip Flory joins as well.
Yes,
it's really, yeah. Let's talk about December corn just a little bit.
Okay.
If I go back to October 2nd, let's go all the way back to October 2nd. We've basically been in what's becoming a steepening downtrend. That $4 mark has kind of been a line in the sand since a month before that, I would call it. Popped back above it on, is that August 3rd here? I don't know, man. It feels like it's getting away from us, brother. We had high hopes,
Yeah. Well, here we are. We were trading at 420 or higher until the middle of last week, right? So around October 9th, leading into the October 11 crop production and supply and demand report, we were still above 420 in harvest with a record yield. I mean, how in the world was that market still clinging to most of a 50-cent rally as recently as Wednesday of last week, a week ago, still clinging to the better part of a 50-cent rally in the middle of harvest. It was quite astonishing to me. The ability of it to do that was really impressive. Now, the line in the sand isn't $4. The line in the sand is $4.20. You get below 420 and look out. It opens upside risk. It opens downside risk. Conversely, going back up through 420, the last couple of times that we've done that, I believe with back-to-back higher closes, it's been worth 10 or 15 cents, but that 10 or 15 cents has also turned into some pretty aggressive farmer selling in here.
Yeah.
So there are a lot of moving parts in this corn market right now. Darin, I think, did a nice job of laying out the idea that demand is probably better for corn than most people and most analysts anticipated at this point. Exports are doing better. The margins are still good on corn on ethanol. So there's some, and then you look at the price of cattle, not so much the price of hogs, but the price of cattle, and it's helping out our feed demand there too. So it's digesting and having to absorb just a huge amount of information right now. And quite frankly, if we can trade this thing in a 30-cent trading range, now that means that D's Corn's going to have to catch a bid tomorrow, really, after 4 closes below the opening range and near session lows. I mean, that's just momentum and buying interest just draining out of the market as the day goes on. And it's happened for 4 consecutive days. So if we can stop that and bring some buying interest into this market right here at $4, give us a chance to trade in that 20 to 30 cent trading range again, I think we'd look at that as another opportunity come the move above 420.
It was interesting to hear Darin Fessler from Lakefront Futures talk about the influence of crude oil over the rest of the commodity world.
Right.
And now we've got the International Energy Agency talking about lowering demand forecasts for 2025. OPEC is cutting back on production. I don't have the story here in front of me. We reported on it, I believe it was this morning. That's not a good fundamental setup for crude oil, Chip. If we continue to see pressure on crude oil, at what point do the grains say, you know what, crude oil, no, you do your thing, we're going to do ours? Does that day ever come?
No, not. Well, it might. I don't have a good reason for it to happen.
Yeah. It would have to be some sort of attitude sentiment shifter, like people, view it as an indicator of something else.
Yeah. So, Darin said the grain markets perform better with a higher priced crude.
Yes.
Okay. Which is right. Which is exactly right. But then we look at some of the policies that are out there and in place, and you've got the left that would like to get rid of fossil fuels, and then you've got a campaigning former President Trump that says one of the ways he's going to keep prices under, one of the ways that he's going to lower prices is to lower the transportation costs by lowering energy costs, by lowering crude oil, by producing more crude oil. So, I mean, you want to talk about swimming upstream.
Yeah.
That's the way it looks to me for the energy markets. And if the energy markets are going to be under, kind of a consistent pressure, I don't know how the rest of the commodity world really even reacts to that, Davis. But I would think that it'd be difficult to build upside momentum.
Yeah. We should get to the weather, but he did raise a red flag on the lean hogs. Lots of air below hogs right now is what he said.
Yep. Yeah, probably not a bad idea to have a price floor under cattle and hogs at this time. All right, let's get to it. The National Weather Service 6 to 10 day outlook. This is for October 21st through the 25th. Above normal temperatures expected over most of the country, and especially over the central and eastern Corn Belt. Above normal precipitation expected over all of Minnesota, the western 2/3 of Iowa, northwest Missouri, and points to the west and north of that. We've got that band of near normal along the Mississippi River, and then we get back to below normal precipitation expected in the eastern Corn Belt. 8 to 14 day, October 23 to 29, above normal temperatures, mostly above normal precipitation. All right, thank you so much for listening today. Come back tomorrow morning. We've got a Farmer Forum right here on AgriTalk.